I am Jamie McDonald. Welcome to Before and After, the twice-weekly market show from Refinitiv. On today's episode, the Before segments will examine the upcoming US retail sales report and the National Association of Home Builders Index. Our After segment revisits US core CPI and what the lack of uptick means going forward. Let's get started with our first Before. When politicians, pundits, and prognosticators discuss the harm of trade wars, they don't talk about soybean farmers losing their income. No, what they say is, you don't want to pay more for that smartphone, do you? Because the American consumer has long been the driving force behind the global economy. And so our first Before today is the US retail sales report. Last month's minus 0.3% change was a shocking miss, considering expectations were for an increase of 0.3%. It was the first negative move in retail sales since February and the first real indication that consumers were scaling back. The Fed, sticking to their policy of good news is bullish, used the weak number as a key data point in justifying the October rate cut. Retail sales are important, particularly in the US. US consumer activity accounts for roughly 70% of the US economy, and over the last 5 years, the consumer has contributed to 85% of US GDP growth. Up until last month's disappointing result, they were showing no signs of slowing or of a pending recession. Often in economic results, one number doesn't mean much, but numbers beget patterns, and patterns beget trends. And trends, well, they are something we all care about. Many different asset classes and corporate results are reflected in that one number. And there's a good chance we'll be watching retail and consumer spending very closely in the coming weeks as holiday season begins. But if we look closer at last month's number, a major drag was auto sales, with its biggest decline since January of this year. It's always best to focus on the key drivers, and since autos were the outlier last month, we're going to focus on a setup in big cap US auto stock, Ford. The S&P continues along with its all-time highs. Ford's chart has decoupled from the S&P in recent months. It's down 13% from its high in June 2019, and obviously does not share in the equity optimism. A strong retail sales report, along with a firming of auto sales, could mean a near-term bottom in Ford as the stock plays catch-up and bargain hunters begin their year-end shopping spree. Ford stock could squeeze higher. The key barometer of used car prices has been struggling as of late, so a weak retail sales number will most likely be very bad for auto stocks. Ford's 9 months lows around $8.40 would be under threat in this case. The stock has continually bounced off the 9-month low, which is barely 5% below current levels. Therefore, there's probably more juice to be had on a rebound if the number can beat expectations. For an economy that is supposedly on the cusp of collapse, home builders seem to be quite optimistic. Home builder confidence last month registered at the highest level since a 5-year peak in February 2018. And this brings us to our next Before topic, the NAHB index. The prior reading of 71 was a fourth straight advance in sentiment, which hasn't happened since the summer of 2014. The expectation this month, no change at 71. A list of plausible culprits looks like this. The 30-year mortgage rate is near 3-year lows. See the aforementioned Fed cuts for an explanation. Southern migration has home builders in the area riding 14-year highs in optimism as Americans relocate to areas with more affordable housing. New tax policies have penalized homeowners with relatively expensive properties in states with higher state income taxes. This data from Refinitiv shows us the US Home Builders ETF as compared to the US Home Builders Index. What this means is that with the Home Builder ETF up 40% year to date, a decline in the index should unlock some profit taking in a sector that has comfortably outperformed the S&P 500. An inline reading or a fifth straight gain, on the other hand, will allow the sector to participate in any year-end gains for the broader market. That was the sound of the door slamming shut on an uptick in inflation. Our after segment looks at core CPI, which came in at 2.3 versus an expectation of 2.4. This is still near the 6-year high, but we were certainly denied a break to the upside. Rent costs and lodging prices were weak and lead the way as far as blame for the total number. Bottom line is this should put a lid on the short-term weakness we've seen in the bond market. The US 10-year, which had flirted with that magic 2% level, backed off and came to rest in the mid 1.8% range. Hello, Goldilocks. Regardless of the indecision on further cuts, it is this kind of data point that leaves the central bank room for more dovish action at future meetings. There it is, US retail sales and the NAHB index in the before, US core CPI in the after. Refinitiv data throughout. This has been the Friday episode of Before and After. Please be sure to like, subscribe, and hit the notification bell. Share us with your friends, and I'll be back on Tuesday.